So tonight's really, really important. We want to cover this article that you read this weekend and just make it really clear in your notes as you're preparing for this. This first paper is not a summary of this article. Your first paper is a summary of this article and our class discussion. So I'm definitely going to add some stuff that may not be obvious from the articles. So it's going to be important that you're taking notes as we go, because I'm going to draw some things out that I think Buffett could have been clearer on, at least for my purposes. He wasn't writing this for an insurance class. He was writing it for his stockholders. So we have a different purpose. So we're going to draw things out here that he may not have intended directly, but there's nothing we're going to draw out that he would disagree with. I'm not going to go off on some tangent that he's not trying to make here. So the question here is, what is he trying to cover and how do you organize it? What I want to do is walk through the article and then go back to our outline so we can make sure we've covered everything and you understand what we're looking for. The rubric for the paper is very, very clear, straightforward. So make sure you're taking notes, very copious notes, so you can get, this is the only thing you really have to work on in this class right now for the next few weeks. So I would say this week and start working on this paper and getting it done so you can come to me with a draft, especially if you're not comfortable writing papers. I won't write your paper with you or sit down and go through it, and I'll go through it in detail if you want to, but more than likely what I'll do is make sure, tell you you've got something big missing here, or you're not, the way you're wording that is really not what he was saying in the article, those kind of things. So the first thing he handles is this term float. He's saying the key to the insurance business is float. Now, he's talking property and casualty insurance. This term float is a little strange on the life insurance side. It doesn't quite work as well on the life insurance side. It works, but it's a little trickier. But it does work very, very well on the property and casualty side. So what is float and what is the cost of float? We have to understand those two things. So we'll look at his definition, and then we're going to actually draw out what his actual definition is, because he gives it to you in numbers, but it doesn't tell you what those numbers are. All right. So you've heard float before. You may have, maybe your parents or maybe your grandparents, they may have floated checks before. I doubt any of y'all float checks. You really can't float checks today because people deposit them really fast, right? There's not much float. But it used to be, if you had $100 in your bank account, you go to HEB and you write a $300 check and give it to them, and you get to walk out with $300 in groceries. And you give them a $300 check and you only have $100. It takes them 2 or 3 days before that check clears the bank. So as long as you get to your bank and get $200 into the bank, you're okay. That's called floating. You're spending money you don't have. And it's perfectly legal. If you don't get to your bank fast enough, then they're going to come after you, and they're probably going to charge you $25, $50 for the not sufficient funds. I don't know if your generation even writes checks anymore. You may be so Zelle and credit cards and everything else, but your parents, and especially your grandparents, wrote a lot of checks. And it take time. They would actually, every night, there are airplanes flying all over the country delivering checks from banks to banks. Pretty amazing. They don't do that anymore. They do truncation now, where they actually process the check. Some of y'all probably deposit checks on your phone itself. So you don't have to fly the check to the bank. They just take that MICR code, and it's fast. So if you try to float a check today, you're in trouble. But that's part of what we're talking about, float. You're spending money you don't have, all right? So that's not quite the float definition here. All right. It is the idea of spending money that you don't have, but more in the context of spending money that's not your money. Think of it more in that terms. And what's another term for spending money that's not your money? Well, borrowing. Debt would be that, wouldn't it? If you borrow money for a car and you buy a car with it, aren't you spending somebody else's money? And you have to pay them back over time. So I think the best definition that you can start with on float is think of it as debt. So what Warren Buffett is saying is the insurance business provides debt that's very different than the debt he can get from the capital markets. So what he wants us to do is says, why does he like insurance? Why does he like borrowing money from his policyholders more than he likes borrowing money from the capital markets? All right. Now there is another definition of float, which he gives on the next page. He says, this is float. Anybody want to guess what these numbers are? Any guesses out there? I think I alluded to it last class. He tells you in the paragraph above. Did y'all get that? This, you probably wouldn't get this in your paper. Y'all see that definition? What is float? Net loss reserves. What are net loss reserves? Net just means net of reinsurance, net of, we'll talk about some of the nets that come out of this, but you know, it's what they pay out in claims minus what they get back from other sources. So net loss reserves, a reserve is a claim they're going to pay in the future that they haven't paid yet. So in 2001, you had the Twin Towers come down at the end of the year. They knew their insurance was going to have to pay for that, but it took a while for the claims to come in. So at the end of 2001, they had to set up a liability saying we're going to have to pay these losses in the future. So net loss reserves are claims that the insurance company is on the hook for, but they haven't paid yet. Loss adjustment reserves that's their expenses, their lawyers, their loss adjusters. It's the expenses they got to pay. Most of it's salaries. They're going to pay in order to pay those claims. So they got to send people to New York City to look at the losses, to assess the loss. They got to pay them a salary. That's the loss adjustment reserves, even though they haven't paid those people yet, and they may not have even flown to New York yet. They know that they owe these claims to these companies. They haven't paid them yet, and they know that when they pay them, they're going to have to send these people out on the field to actually take care of those claims. So that's a loss adjustment reserve. The funds held on the reinsurance assumed and unearned premiums. Essentially, what they're saying is those are the claims we're going to pay the other insurance companies because we help them manage. Yeah, I agree with you, Christina. I wouldn't try floating a check at HEB these days. So these are other claims, but they're claims not to the customers, but claims to other insurance companies because they do reinsurance. And then they have reinsurance that's coming to them, and they have other insurance receivables. You can ignore the acquisition costs, the pre-take taxes, and the other things. These last few are not that important. The biggest chunk of this, which is the overwhelming majority of it, is the net loss reserves and loss adjustment reserves. One thing I didn't mention is this one big one right here, the unearned premium reserves. We'll talk about that more. That's premiums they've received that they expect to pay claims on, but they haven't paid claims on yet. So what happens is you pay your premium and you don't have a claim yet, but you know you're going to have a claim in the future. And so what they do is they say, you know what, we got $1,000 in premiums. And they haven't had an accident yet, but they're going to have an accident in the next 12 months. And it's December. So we're not going to really earn that premium yet. So it's a really strange thing. We'll get into more detail. It's a really bizarre thing for insurance. But it's essentially reflecting the fact that 70–80% of premiums that you receive are going to be paid out in claims and loss adjustments. So you get the premium in and you set up this reserve. So essentially what these are is what they're saying, it's our customers' money. They've paid premiums, they've had losses. We haven't paid them their losses yet. So it's really their money. We're going to be paying this out. And so essentially we're borrowing money from our customers. And you can see the different companies, Geico you've heard of, Gen Re, other reinsurers. So it jumped from 27 billion to 35 billion because of 9/11. And most of that coming from the reinsurance side. not from Geico. Geico didn't have a big jump. In fact, Geico was kind of normal, but coming from Gen Re and other reinsurance. All right. So another way to think about float is not necessarily borrowed money, but rather it's the funds, the premiums received to customers, and the claims owed to customers that haven't been paid yet. So think about it as other people's money. All right, so there's 3 ways to think about float. In your paper, you definitely want to define float. That's a big part of the paper. And you really want to try to hit those nuances of float because they've all got a kind of a importance to what he's talking about here. I think the debt definition is probably the biggest one from where he's coming from, because he's arguing that insurance is a good business because his cost of debt when he borrows from his customers is a lot cheaper than his cost of debt when he borrows from the capital markets. That's a big part of his argument. All right, so there's the float. Any questions on float? Anybody see anything in there that jumped out at you as, here's the other definition he has, which I think I kind of use that. Float is money we hold but don't own. Here's another definition. This one's actually pretty important here. Make sure you get this in your answer. A big part of float is time. There's an interval between when they collect the premium and they pay out the claim. That time is really, really important, that part of the float. So make sure somewhere in your answer you have that time interval. I kind of implied it in what I was saying, but that's really, really important. And it can extend over many, many years. If it's auto insurance, physical damage, it's not going to be many, many years. If you have an auto accident, you're going to get your claim paid within a few weeks, pretty fast. But we're going to talk about asbestos. If the claim is for asbestos, that can be over 30, 40, 50 years. So sometimes this money that you hold, that's other people's money, you may be holding for 40, 50 years. All right. Now be real careful. Float is not this next part. Float is not they're investing that money and making earnings on the investment side. Float is the liability that creates that investment portfolio. The investment portfolio is not the float. Okay, y'all understand that? The float is the money you're getting from your customers, that you're holding for your customers. It's that liability. Float is the capital side. It's the borrowed money. While you're waiting to pay your customers, you're going to invest that float and hopefully make money on the investments. But those investments are not the float. The investments is what you're making by investing the float. All right, it gets a little confusing. So kind of think of it as float as you borrow money from a bank. So you borrow $10,000 from the bank. You then invest that in the stock market and you make 6%. You pay the bank 4%. Your float is the money you borrow from the bank. The $10,000 you invest in the stock market is what you did with the float while you're waiting to pay the bank back. All right. So the float is the borrowed money. All right. He mentions an underwriting loss. So we're going to get to the cost of float now. What is the cost of float? And he says the cost of float is the underwriting loss. So what is an underwriting loss? Very simple formula. It's the premiums minus the claims minus the loss adjustment expenses minus other underwriting expenses. All right. So there's 4 things to it. Premiums minus claims minus loss adjustment expenses minus other underwriting expenses. It does not include the investment income you made off of the investing the float. All right. Underwriting loss has no investment income in it at all. I think he might give you the definition of float costs over here. Somewhere in here. I think he defines it, but if not, you got to have that definition. The definition of float is the underwriting loss. So insurance companies, you look at an insurance company, they break their income statement in 2 pieces. They have the underwriting piece that comes first, and then the investment income that comes separately. The underwriting is just premiums, losses, loss adjustment expenses, and expenses. And then the investment piece is what they made by investing the float. The investment piece is not the float. It's the earnings on the float. All right. So underwriting loss is how much is that float costing you? And this is a really key term right here. An insurance business has value if its cost to float over time is less than the cost the company otherwise incur to obtain funds. So you now know, if you have Geico insurance, you now know what Warren Buffett thinks of you. He thinks of you as a cheap source of capital. And he's telling you about it in his annual report. You're not a customer, you are a lender. And he thinks you lend at below market rates, and he's more than happy to take advantage of you. If you're willing to lend him money at below market rates, he's more than happy to take advantage of you and borrow at those low rates. Questions on that?
I was curious about the adding on to the cost of float. I didn't see him mention anything about them issuing new stock. Like, would that be technically a cost of float or not?
Well, their equity is part of their cost of capital. The float here is really on the liability side. So if you're looking at a business, you think about their cost of capital, you've got debt and equity, you might have preferred stock. What he's saying for an insurance company, they've got debt, they got preferred stock, they have insurance reserves, and they have equity. And insurance reserves is just part of that capital formation. So equity's in there as well, and they do have cost of capital for equity, but here they're just talking about the cost of capital of the debt side. So he says, I can borrow money from my policyholders, or I can borrow money from the debt markets. I can also go out and issue stock that has a different cost of capital, but right now I'm just comparing borrowing money from my policyholders versus borrowing from the debt markets.
Okay, thank you.
Sure. Now, what he's going to argue is the cost of float in most years is actually negative. What he's saying is, for especially Geico, for a business like Geico, he borrows $1,000 and he pays back $960. If you could borrow money and pay it back 4% less than you borrowed, how much would you borrow in that case? I loan you money, you need to pay me back a negative 4%. How much would you borrow from me?
Everything.
Everything I give you, right? If I give you $1 trillion, you take $1 trillion, stick it in T-bills, and then pay me back negative 4%. So he's saying in good years, in normal years, his cost of float is actually negative. Now, there's more to it than that, and he's not getting into the nuances of what Ryan was referring to, which is the cost of capital, and there's some other things going on here, definitely, because it's very risky debt. It's very unlike other types of debt. But he's essentially saying, yeah, this is a really cheap form of debt. Berkshire has obtained its float at very low cost. Indeed, our cost of float has been less than zero in about half of the years in which we've operated. That is, we've actually been paid for holding other people's money. But in 2008, it was terrible. Why? Because of 9/11. And that's the nature of insurance, especially reinsurance. The nature of reinsurance is you make a lot of money, make a lot of money, make a lot of money, and in 1 year you lose a lot of money. And you hope, and this is pretty important when we get into how you manage this, you hope that that 1 year you lose a lot of money doesn't completely wipe out all the years you're making money. And there's really no way to get around that with reinsurance. It's just the nature of the business. That's not true of Geico. With Geico, he's probably getting paid for holding people's money almost every year. Now, one term you need in here, you might want to look up. When you talk about the cost of float, is something called the combined ratio. Let's talk about the combined ratio here. I've probably not heard of the combined ratio. It's very specific to the insurance, P&C insurance industry. It's not used in life insurance. So we're going to come back to these other notes here. So the underwriting gain or loss, if you have an underwriting gain, that means your cost of float was negative. If you have an underwriting loss, that means your cost of float costs you money. Your underwriting gain or loss are your premiums, minus your losses are your claims, your loss adjustment expenses, underwriting expenses. There's something called the combined ratio. I don't think he uses it in his article. Someone might do a quick search and see if he does. I can't remember if he did. But he does tend to jump into combined ratio a lot when he's talking because he just assumes people know insurance talk. Essentially, combined ratio is your outflow over your inflow. So you take this underwriting loss or gain, and you take the three things you subtracted, losses, LAE, and expenses, and divide it by premiums. If you have an underwriting loss, your combined ratio will be greater than 1. Because if your losses, LAE, and expenses are greater than your premiums, you had a loss, so your combined ratio might be 105, 110. If you have an underwriting gain, your combined ratio is less than 1. It might be like for Geico, it's usually like 0.94, 0.95. If you have an underwriting gain, you essentially have a negative cost of float. All right, so that's the combined ratio. They don't use combined ratios on life insurance. It's very specific to the property and casualty world. Again, it excludes investment income. Everybody understand that? Some students get a little confused on that combined ratio. It's our CEO we had at USA, he hated some of these ratios because in his mind, if a number goes up, it should be good. And if a number comes down, it should be bad. But here with the combined ratio, higher is bad, lower is good. And he didn't like that. I was like, hey, I want numbers going up. I always want numbers going up. So he would actually flip some of these numbers upside down just because he liked it better that way. But here the combined ratio, higher is worse, lower is better. Below 1, you're making money. Above 1, you're losing money on your underwriting. Because remember, there's no investment income. So it's possible you have an underwriting loss, but you're making money because you're making so much money on your investments. All right. Now, real quick, this isn't part of the article, and you don't need this in your paper, but I do want to bring it up here. There's something called the underwriting cycle. In fact, I think one student was going to use this as their topic for their second paper in one of my classes. I don't know if they did. You certainly could. There's a lot written about it. But the underwriting cycle, what that means with insurance is when interest rates are really high, insurance companies make a lot of money on their investments, which means they can have larger underwriting losses. And when interest rates are really low, they tend to have underwriting gains because they're not making as much money on their underwriting. So if you go back and do a regression between combined ratios and interest rates, you'll discover when interest rates are high, combined ratios are high. Because when interest rates are high, if you're making 9, 10% on your investments, you can lose 5% on your underwriting. But when interest rates are really low, like right now, like 2 or 3%, underwriting combined ratios tend to be like 0.94 and 0.95. So right now, combined ratios tend to be below 1, mainly because interest rates are really, really low. So insurance companies tend to have larger losses when interest rates are high and have smaller losses or even gains when interest rates are low. So that's the underwriting cycle. The underwriting cycle was really, really pronounced and really obvious for many, many years. And then Geico and Progressive showed up, and you stopped seeing the underwriting cycle because they got so competitive. So competition kind of made it disappear there for a while. But that is the underwriting cycle. All right, everybody understand the combined ratio, the underwriting gain or loss? That's how he's defining the cost of the float. The higher the combined ratio, the more expensive the float is. Which means if you're looking at an insurance company, if you're interviewing with an insurance company, the combined ratio is one of the things I would definitely be looking at. I think it's a really important concept. All right. So he said last year our cost of float was 12.8%. Another way he could have said this was last year our combined ratio was 112.8. 112.8. Y'all see how that works? If your combined ratio is 112.8, that means your cost of float was 12.8%. You paid out 12.8% more than you took in. And that's why he's talking about his cost of float. So there he's alluding to the combined ratio, whether he uses it or not. And why is that? Because he's in the reinsurance market. Reinsurance market insures catastrophes, those things that happen very infrequently, but when they happen, they're huge. And 9/11 hit in 2001, and he had a huge payout, so he lost a lot of money in 2001. Here he talks about the underwriting cycle. Some years, float costing, say, 4% was tolerable because government bonds yielded twice as much. You'll see the underwriting cycle. When interest rates are high, you can tolerate a cost of float being high. When interest rates are low, you need a much lower combined ratio. All right, we're going to shift gears here. So hopefully everybody knows what is float, what is the cost of float. There's several things in there. So make sure you're catching all of the aspects of it. You know, I really want you to be really, really detailed in your answer. Now, where do we shift? Now he's going to say, well, we know what float is. We know what the cost of float is. How do we manage this? How do we manage this cost of float so we have a profitable, viable business? So that's what he talks about, the principles of insurance underwriting. You see that word underwriting, what it means is the part of the business that excludes the investment income. You have underwriting and you have investments. So he's not talking about the investment piece. He's not saying, what are we investing the money in? What he's saying is, how do we manage that underwriting piece? So he says most of his competitors are pretty mediocre. And he's saying they're pretty mediocre because they're not following his underwriting principles. And he's also going to say in 2001, they didn't follow their underwriting principles either. All right. So you get to this part of the paper and it looks like there's three things. I'll give you the third one. The third one is 101. All right. Avoid business with immoral people. That's true for every business. I'm not saying it's not important. I'm just saying it doesn't specifically apply to insurance. So don't do contracts with immoral, unethical people. All right. So I'll give you that one. That's an easy one. Put it in your paper. I'm perfectly happy. What you need to be careful of is rewording these into your own words and making sure you see all of them. So let's look at this first one because there's more than one in this first one. They accept only those risks they are able to properly evaluate. There's one right there. The second one, even after remote loss scenarios, they have an expectancy of profit. We'll have to talk about that one because that one's a little confusing the way you word it there. There's number two. They ignore market share considerations and are willing to lose business if their competitors are offering terrible prices. So three things right there. Y'all see those three things. Properly evaluate. They can still make a profit even in a remote loss scenario. And if the competition's offering foolish prices, they're willing to lose business. I don't know if y'all know what the word sanguine means. I can never remember if it means happy or if it means indifferent. It's one of those two words. I should look it up. His vocabulary is a lot better than mine. Sanguine definition is...
It says optimistic, so...
Positive. So it's positive. It's not indifferent. So I kind of question if he's really saying, hey, I'm really happy about losing business. Maybe he's happy about losing business because his competition is going to go out of business. Maybe that's the concept. I think he's saying be indifferent, you know, hey, the competition wants to offer a price that's too low and they're going to lose money, then let them have it. We're not going to follow them down that path. We're not going to let competition drive us into insolvency. So they're sanguine about losing business. All right. So there's three things there. If you only put one thing there, you're going to lose value. So you're going to lose points. So what I recommend you do is not quote this in your paper. Don't quote this and then talk about it. What you should do is do number one, able to evaluate. Number two, still get a profit even after remote loss scenarios. And number three, be willing to lose market share. All right, there's three things there. Make sure you number them 1, 2, 3. Not to make it easier for me to grade, but to make sure you don't leave one out. Okay, it's in the rubric like that. If you look at the rubric has those three, but just make sure you number them separately. All right. So the first one, able to evaluate. That's the actuarial side. Now, if you want to get full points here, there's two words I need in your answer there. I need to see the words frequency and severity. That's what we mean by able to evaluate. You can put statistics down for frequency and severity. Y'all remember that? Frequency, the probability of loss, severity, the average loss. If actuaries can't figure out the probability and then the average loss, they can't write this business. It's just too difficult. Staying within their circle of competence. So if they don't have some competitive advantage, they don't have actuaries that understand this business better, at least as well, or not better than the competition, they shouldn't be writing that business. You need to understand the business extremely well. And actuaries are incredibly specialized people. They tend to focus in on one or two product lines that they know extremely well. That's just the nature of the business because the math and the data is really difficult. So you want people who know what they're doing. All right. So there's the first one. The second one is after they've done all the evaluations, they looked at everything they can look at, and they run a remote scenario, really bad catastrophe, they still expect a profit. Now, I want you to modify this a little bit. I do not believe he's saying they make a profit every single year. I still think he knows with the business that he's in, there's going to be some years where he's going to lose money. I really think he means over the entire cycle, most years you make money, every once in a while you lose money, but over the cycle, you still make your cost of capital. All right. I think he would admit he's in a business line where you cannot make money every single year because he's insuring these really extreme risk events. Every once in a while, he's going to have a loss because otherwise no one ever buy his reinsurance. If he's always making money, what are they buying the insurance for? All right. So that expectancy to me is not every single year. It's over time. Now, has the industry had cases where they didn't do that? And the one I heard I thought was the most amazing is when the Northwood Ridge earthquake hit. That earthquake event, if you looked at the losses the insurance industry incurred, it wiped out the previous 30 years of premiums, not of profits, but it wiped out 30 years of premiums. That one event completely wiped out that entire business. That's really bad insurance. In 1 year, you wipe out 30 years, not of profits, but of revenues. So obviously they were mispricing earthquake, and suddenly earthquake premiums went up dramatically after that event. We'll probably talk a little bit more about Northridge as we get closer to talking about catastrophe risk. All right. So the first one is make sure you can evaluate the risk, make sure you have frequency and severity in your answer. The second one is even remote loss scenarios, you should still make a profit, maybe not every year, but over time. And then the third one, charge the price that makes sense. And if the industry is overly competitive, still charge the price that makes sense and be willing to walk away. Why? Because Berkshire Hathaway says, you know what? If I got to pay, if I'm going to lose money on the insurance, I'll just instead go out and borrow money in the capital markets. So if I got to lose 6-7% on the insurance, I'll just go out to the capital markets and borrow it 2 or 3%. I'd much rather do that. Berkshire Hathaway is a very highly rated company. They can certainly get away with going out to capital markets and borrowing money. Okay, everybody see the first three? Now, we're going to come back to this remote loss and add a little bit to it. So let's get to the next one. One thing he adds to that remote loss is this term aggregation of losses. So what he means here is that remote loss scenario, it could be one big event, or it could be 5 events that together are one big event. So that's what happened to him in 9/11. In 9/11, it didn't look like one event, it looked like multiple events, but it just happened to all happen in the same building. So he was insuring all these different employers, and he thought, well, we're diversified. He never stopped to think that they're all in the same building and that there could be an event that could have hit them all at the same time. And so that's this last part. And I love this term, ceaselessly search for possible correlation among seemingly unrelated risks. You can quote him on that one. So there's really 3 things going on here. So on the remote loss possibilities, he's talking about not just one event, but the possibility of being multiple events that somehow correlate with each other because of something he didn't think of, like a 9/11. He thought it's a diversified, and then he discovers he's not diversified because there was something that linked all of these events together. All right, I don't actually separate those in the rubric. We'll look at the rubric so you can see it. I combine a few of these together, but I like to put this, the expectancy of profit includes remote loss possibility. So that's one. And then you go in more detail on the remote loss possibility. We're talking about either a single event or multiple events that suddenly become correlated because of something we didn't think of. All right. Now, is it possible you have multiple events just because of pure random bad luck? So Japan has a major earthquake at the same time Florida has a major hurricane. And I'm not talking about a 1 in 10 year, 1 in 50 year event. I'm talking about something we've never seen before. An earthquake far worse than the last earthquake Japan saw. Or a hurricane far worse than the hurricanes we've already seen, far worse than Katrina. Is it possible in the same year Japan could see an earthquake far worse than what it's ever seen before, and Florida could see a hurricane far worse than it's ever seen before? That's pretty unlikely. Those are extremely rare events. It's possible, but extremely unlikely. So he's really more focused on these are extreme events, and they all happen together because there's something that linked them. All right. That's going to be important when you get to the last thing I want you to talk about, which is that page 10 assessment. We'll get into that a little bit. All right. All right, so we really got 4 things so far. Able to evaluate frequency and severity, remote loss possibilities, you still get a profit over time. Number 3, willing to walk away from business if the competitors are mispriced. Number 4, related to the remote loss possibility, it could be one event or it could be multiple events. They're somehow correlated in ways we never thought of. Those are the 4 things we have so far. Any question on those first 4? You can flesh those out. Obviously, there's a lot more you can add to that. We talked about avoid business with more risk. So let's get to the 6th one. So that one's number 5, and now let's get to number 6. Number 6 is where students lose most of their points, beyond a doubt. And I don't know why I'm such a horrible professor on teaching this. So the key here is ask me questions, because obviously I'm horrible at this, and I'm telling you now I'm horrible at it. So I'm opening it up to ask questions. What am I not saying to help you on understanding of this? Part of it, I think, is because I'm talking about stuff that he's implying in what he's writing, but he's not explicitly saying it. So you're going to have to write down the stuff I'm saying in addition to the stuff he's saying, so you make sure you have You have the connotations here. He is talking about it, but he's not explicit about it, all right? So number 6 is experience versus exposure. All right? Experience versus exposure. So he says a big problem in insurance. Are y'all seeing this, Ryan? Are you seeing, when I highlight the article, are you seeing that? Okay, good.
Yeah, I see it.
Good, thanks. So what is experience? What is exposure? Experience is really easy. Experience is your historical frequency and severity. Real simple. It's just your history. Like we talked about in my previous class, risk management. It's that history as your sample size. So experience is very easy to explain. What is exposure? Exposure is much, much more difficult. So exposure is essentially what you could lose based on what you're insuring. It's not what you expect to lose. It's not a particular number, but it's what you could lose. Now, it could mean, what if every single policyholder filed a claim next year? Well, obviously that would put them out of business. But in a way, he's kind of hinting at that. Our exposure is, what are we promising to pay if something goes wrong? So in a way, it is kind of everything he's insuring. But another way, what he's saying is, what could happen that's never happened before in history? What are we truly exposed to? History is not what we're exposed to. We didn't promise to pay you only if it relates to history. When you buy auto insurance from Geico, they will say, hey, we're going to pay your auto claims. Well, unless our claims are higher than what we thought based on history. No, if they have a bad year and they have more auto claims than they expected based on history, they still got to pay you. And so that's what he's saying the exposure is. So it's kind of a tough thing to explain, but experience versus exposure. All right, so you got to explain that. What does he mean by that? Experience is what you've seen in the past. Exposure is essentially what could happen based on the promises you're made, and that could be completely unrelated to experience because something changes in the world. All right. Questions on that? Y'all see that? Now, the second thing here is to ask the question, when does experience lead you astray? And this is where some students completely leave this out of their paper, even though it is on the rubric. All right, it's sitting there on the rubric and some students just completely leave it out. It's 10% of the paper. So, and there's 2 things. He doesn't tell you what those 2 things are, except he gives you examples. And examples he gives show the 2 things, all right? So very, very important here. What are those 2 things? Number 1 is when there's not enough experience to predict the future. It's such a low frequency event. We just don't have much data. So earthquakes is a perfect example of that. There just are not, now I know there's been a lot of earthquakes, but we're talking about the major earthquakes that do major damage. There just have not been that many, especially in the United States. I know we keep talking about the big one that's going to hit California, but it really hasn't hit yet. Northridge was not that event. So California has not had that big one yet. I know we saw that volcano erupt here a few weeks ago. That was pretty major, but it didn't cause that much property damage. So we haven't really seen it yet. And it may not be California. There's a fault that runs through Kansas that's been dormant for a long time. It may not be dormant tomorrow. Who knows? You know, Texas has some fault lines. I bet most of y'all don't buy earthquake insurance, but Texas has fault lines. Texas could certainly have an earthquake. So what he means there is just the frequency is so low. We just don't have much data. We're trying to price insurance off of something that hasn't happened much. Another example might be terrorism risk. There weren't that many terrorist events in the US. There were major events like 9/11. You didn't have much to draw on. All right. So that's the first one. And what you want to do in your paper is to find that first one and give some examples. Where you can really get some critical thinking points is add an example that's not in his article. All right, if you can think of some others. All right, that's the first example where experience leads you astray. The second example where experience leads you astray is when the distribution is changing, where history is a false indication of the future because something has changed. So the example you hear of that the most often is global warming. So if global warming is causing waters to get warmer and it's going to cause stronger hurricanes, then history is not much value to you, because future hurricanes, there's going to be more of them and they're going to be stronger. So if you think global warming is really warming the jet stream and all of that, we're going to talk about that when we talk about hurricanes. If waters are really getting warmer and that warming is much deeper, such that the cold water is not killing the hurricane and they're getting stronger and more frequent, then all that history of hurricanes, even though we have a lot of history, a lot to work with, that history is going to lead us astray because the frequency severity is actually going to be different in the future than it was in the past. The example he gives is D&O insurance, the directors and officers insurance. It's a really good example. What he's saying is directors and officers insurance is when stockholders sue directors and officers because they made a bad decision and it caused the stock price to fall. What Warren Buffett is saying is when the stock market's been up for 10 or 12 or 13 years, you don't get many D&O claims because their stocks are going up. You don't sue a company when your stock's up 50%. Well, when the stock market crashes, that's when you get a bunch of D&O claims. So if you're sitting there after a 10-year stock market and you look back historically and say, wow, D&O experience has been really good. We've had very few claims. That might be the point where your experience is about to radically change. You're at the top of the market's about to crash. You're about to get a lot of new D&O claims because the stock market's about to crash. That's when people sue. And so he's saying experience might lead you astray. At the point in time where your experience has been really good, is right in the point in time where you should be worried about higher claims. It's kind of like Caleb Neeson. He's talking about the turkey experience. You know, the turkey's trying to forecast his future. So January, February, he's getting fed and he's like, wow, this is pretty good. March, April, May, he's getting fed. June, July, August, September, they're feeding him. And suddenly September, October, they're feeding him really well. He's like, man, this is great. My recent experience is great. If I use my history as my forecast, boy, this is a great time to be a turkey. And then Thanksgiving comes along and whoa, I didn't do a very good forecast there. That was probably the worst time to be a turkey. That's essentially what he's saying is the distribution has radically changed. And D&O is radically changed for very good reasons. What did I talk about in my previous class that might explain that? Anybody know? What did I talk about in that class? Starts with an R. Reversion to the mean. I can't get to the chat fast enough. Yeah, Martha's asking, does exposure, is it based on statistics as well? It is, but Martha, a lot of those statistics are based on what? On history. So the challenge of an actuary is I'm pricing based off of history, but I need to make some adjustment to that. So if they suddenly change speed limits from 55 miles per hour to 70 miles per hour, like they did about 20 years ago, what does an actuary do with that? That historical experience is not all that useful anymore because we know speed limits have increased. We know there's more accidents, so frequency goes up. We know there's more dangerous accidents. Severity goes up. So Martha, I don't know if Martha, if you're a finance or actuarial, but actuaries are trained when they see those changes, how do they adjust their numbers to try to account for that? They try to go to a period historically earlier, or maybe they look at another country that's done something like that. Or maybe they just use their rational, whatever best they can come up with to try to approach. Maybe they put conservatism in it. They intentionally overcharge just in case. Who knows? But they got to do something in those cases. But yeah, so exposure is based on statistics, but the exposure statistics is heavily dependent on experience. And so what Warren Buffett is saying is there are times where you've got to accept that experience could lead you astray, and you need to think differently about what your exposures actually are. There's sometimes where that experience is just inadequate. You don't have enough data. And in that case, you maybe don't insure that at all, or you price it very conservatively. There's other times where you know the world's changing and that experience may be giving you a false piece of information. And terrorism might fit in both of those categories, right? Not much experience and the world may be changing. Who knows? All right. Anybody want to try to reword that in your own words? Anybody got it? What are the two things you need to talk about under experience? I know because it's 9:50, no one wants to do that. I know it's, if it is 7 o'clock class, everybody be talking. And there's someone on this Zoom that's not understanding it, but they're not letting me know. So there's probably several. And I know that because of prior papers. So because I just did a horrible job explaining it to you. I know that because of prior papers. What can I do to help y'all understand? You've got to talk about two
So
times.
what you make me understand when it comes to experience is just to evaluate what has the past been shown, what is currently be predictable on the current situation of the house, the business, where is it located. I kind of like, that is what you're trying to say with experience. When it comes to exposure, you're pretty much letting us know, hey, think outside the box, think about situations that could be drastically out of proportions, out of anybody able to handle. And 9/11 is one of those situations.
Right, 9/11. Yeah, that's a good way to discuss it. When you talk about the experience, Ricky, make sure to put some comment about frequency and severity. I want y'all always thinking frequency and severity when you thinking insurance, all right? It's always an important concept. So experience is those historical frequencies and severities. And I like, Ricky, what you're talking about, a house or a business. On exposure, that's a good way to think about it. I'm insuring this house right here. This house right here has never experienced an earthquake. Does that mean it never will experience an earthquake? Where's the fault lines? When's the last time a fault line here has changed? What do we know about earthquakes and fault lines? What could happen here? That's the kind of thing on exposure. You're thinking, like Ricky said, thinking outside the box. What could happen here? We're insuring this business and the Twin Towers. We're doing workers' comp on this business and the Twin Towers. What could happen to this business that could cause some problems? So they're in this building. Could something happen to this building? Oh, this building was attacked someone set off a bomb and y'all remember before 9/11, there was a bomb set off in the World Towers, World Trade Center, set off in the parking lot. Okay, there was an attempt to destroy this building before. Would that happen again? What would happen if someone tried to do that? Maybe it was unthinkable. I think flying 2 planes into buildings, that seems pretty unthinkable. But someone tried to set a bomb off in the building, so you know they're thinking about it. I don't know, should they have thought about that when that's what I think thinking outside the box is a good way to put it. You're really going to those extreme scenarios and saying, what do we have not thought of before that could cause this entire building to come down? And every employer we're insuring in this building would have a major, major loss all at the same time.
Yeah,
So
another thing that you can think about, like exposure wise, is also like how schools, higher institutes, facilities have been emphasizing on active shooter training for students and staff. If you think about it, that is it is, I hope doesn't happen, but hey, it can always happen. You know, there's that one particular aspect.
Yeah, I mean, if you think about some of the events, one thing I do, this is a horrible way to do it, but if I were insuring this kind of things, I would put myself in the mind, if we're talking about terrorism risk, I would be thinking like a terrorist. We want something that's big, it's going to hit the news, it's going to cause a lot of pain and suffering, it's going to cause a lot of fear. What could I do to cause that? And so you have to kind of put yourself in that mindset. That doesn't work well with hurricanes and earthquakes. You can't put yourself in the mind of an earthquake. But there certainly are research papers out there on hurricanes, research papers out there on earthquakes coming out of academia and other places. Obviously, a firm like Berkshire Hathaway is reading all of those papers. They're in tune with all of that and they know what's going on. But yeah, you're really asking those tough questions about what could go wrong. Sometimes they get a little crazy. My boss, was trying to think of a worst case scenario, and he said, what happens if a hurricane comes across the Atlantic, and on the way it picks up some new virus, and it hits the US, and we get this major hurricane, and we also get the pandemic. I thought, okay, I don't think a virus could survive a hurricane, but okay, maybe that seems a little crazy, but that's thinking outside the box, maybe a little wild. But that's what we did at USA. We're sitting there thinking, what could combine, two things combined that we never thought about combining. And that's the other thing on exposure is thinking not just this particular event, but how that event could mushroom and affect other things around it. Okay. All right. Sounds like Ricky's definitely getting it. Hopefully the rest of y'all are hearing that. This is one, if you're really uncertain about my class, you've never had me before, you might call me and read me this section of your paper, just to make sure you're not missing something major here. So he says the correct rate for D&O at the top of a stock market, where it could be reversion to the mean, could be 5 times or more expensive than what experience says. Experience might be so ridiculously low that it implies a premium that's like 20 cents on the dollar what you should be charging. Now, I will show you later in the class, there is a relationship between earthquakes and terrorism risk that's really interesting. It's called a power log. Terrorism and earthquakes both follow a power log. The problem with the power log is it doesn't follow the normal distribution, where you have this tail that gets real thin. What a power log does is as you go out on distribution, the losses don't go up 10% or 20%, they go up 5-fold. So y'all know this, right? On the Richter scale, a 4 on the Richter scale earthquake doesn't do 1/2 the damage of an 8 Richter scale earthquake, right? An 8 Richter scale earthquake does thousands of times more damage than a 4 Richter scale. And that's that power log. Same thing on terrorism. We have a bunch of these small terrorism kind of events that might kill a person or 2 people, might do some property damage. And you've had these people setting off a bomb in a subway or something like that. But occasionally you get the 9/11 or what happened in Paris or something like that, where you're just off the charts and it's massive. And there's a book that actually compares the power log of earthquakes to the power log of terrorism risk. And it's actually amazing how similar they are. So that's the other thing you look at. These extreme events, they don't happen very often, but boy, when they happen, they're massive. We need to be aware of that. Okay. Insurers have always found it costly to ignore new exposures. That is the case with terrorism. So he's really focused on terrorism risk here. We really haven't had any major terrorism risk since the time. We've obviously had some, but they haven't been, we're talking, if you're a terrorist, you're trying to change, you're trying to impact the entire culture. You want people scared to fly. You want to make TSA put you through a major hassle to get onto a plane. It's hard to create an event like that that really scares people to death. And that's why you attack airplanes. People are already scared of flying. You attack an airplane and then they attack a building at the same time. That was an event that really had an emotion. You saw the one in Paris. I forget how many sites they attacked all at once. But those kind of things that you try to have an impact, those are really tough to do. It's not that easy to do something that really impacts and hits the news like that. Here's what he says. He says we do know this. I'm not sure I agree with him on this. You see if you agree with him. He's talking about terrorism. He's saying the probability is very low, but not zero. Okay, I agree with him. It's not zero. Is it very low? It must be very low because we haven't seen one in 20 years, except for unless, you could count the Paris one, maybe. I don't know if there's other ones you could think of that would count in that category. We've had a few others where, tens or 20s of people have died, but 3,000 people dying in a terrorism event, that's a pretty major event. He says the probabilities are increasing. Do y'all agree with that? Could you make an argument after 9/11 the probabilities actually decrease because of the extreme actions taken by our government? I actually think our government really messed up 9/11. This is something they probably should have seen coming. But you could debate that. There's obviously been a lot of articles written about that. But should they have kept it from happening? He says it's increasing, irregular, and immeasurable. I don't know if I agree with that or not. I do agree that while fear recedes, the danger doesn't. So, and the war on terror can never be won, mainly because, you know, people are just, they're going to look for things to do, and eventually someone's going to figure it out and is going to do something. You know, governments can't think of anything. It makes me nervous. The TSA, one point they're saying you can't do this, and the next point they can't do this. You can't take toothpaste on the plane anymore. You can't take bottled water on the plane anymore. You know, these kind of things. You know, they keep changing. They're checking your shoes at one point. They're not checking your shoes. You know, who knows? Until now, insurers and rears. And there's another word, blithely. I can't remember what blithely means. I don't know if it means the same thing as sanguine. I get those two words mixed up. I wish you weren't so smart. So whatever blithely means, try using the word blithely in a sentence, in a conversation this week, and see what your friends think. Unless you read a lot of Charles Dickens, you're probably not using that word a lot. All right, so blithely is the kind of the nonchalant, casual. So sanguine is like you're happy about it. Blithely is you're just indifferent. Okay, so I wish I could remember those two. So try using blithely and see if you can use blithely and sanguine in the same sentence this week. I bet you'll get some strange looks from your friends. So blithely, you know, just kind of without really thinking about it, just assuming these events. Essentially, he's talking about risk ignorance, taking on risk without fully understanding what you're doing. And Lindy's saying, yeah, maybe technology is making one of these massive events more possible. People have talked about autonomous vehicles. We have autonomous vehicles all using the same software. So maybe we are going to be in the case where someone could cause every car to crash at the same time. Who knows? We got all these planes flying with automatic pilots using a lot of software. Could someone somehow tap into that and make all these planes crash at the same time? So we do have, I agree with you, Lindy, we do have a lot more technology that is somewhat intertwined. And so who knows what we're doing here. Yeah, I mean, it's the hacking in and all that. I'm pretty amazed. You know, I hear these stories about Iran hacking into U.S. government's websites. You know, you think, you know, Iran has the technology people just like the U.S. does. To, you know, U.S. has done that to Iran, hacking into their websites and causing harm. And you know, it's just, you hear that the U.S. government's not all that good in its risk controls and some of its websites. You know, that's that blithely that goes even beyond the insurance industry. And then his last thing is probably true. In a close to worst case scenario, the entire insurance industry could be wiped out without the government stepping in. There probably is a scenario like that that really could wipe out. Now, the interesting thing here is it would probably wipe out the commercial side of insurance, but I doubt it would wipe out the personal lines. So I don't know. Can you think of a terrorism risk that would really wipe out State Farm and USAA? Maybe the autonomous vehicle thing. You have all autonomous vehicles, but if you're doing autonomous vehicles, I'm not even sure USA is even insuring that. We're going to talk about that.
What if
Maybe
they
you don't
could,
need
hack the power grid somehow and everybody's power went out? I'm sure a lot of houses, you know, plumbing would freeze, and there would be big problems if they were able to do that nationwide.
Pipes burst. That's possible. Insurance companies do have outs for some of those things. So, you know, I'd have to read the technical language in the policy that you may be protected from that. That's why it's really important when the president says this is a war on terror, and insurance companies say, hey, that was a war. Someone's attacking us. It's war. We don't pay for war risk. is that how we get out of this? So, so we'll see. But yeah, so it's possible on the personal line side. I think it's more likely on the commercial side just because those are assets that get a lot more press. People really notice that a lot more. But if someone could come up with that, yeah, it's possible. So there are definitely terrorists out there with really good computer skills that are learning and hacking in these things. So essentially he's saying the only ones who can really insure these is the US government. The US government actually did step in after 9/11 and provide some backing for terrorism risk because real estate companies were saying we cannot build buildings, especially high-rise buildings. We cannot build buildings unless we can somehow figure out how to insure terrorism risk. And so the government had to step in and provide. So one of my students actually wrote a paper on that particular insurance. All right, so I'm not sure I agree with all of these, especially that probabilities are increasing, and I'm not sure. I'm kind of more in Lindy's area that it's maybe not the probabilities are increasing, but maybe the severity is increasing. So maybe the probabilities are about the same, or maybe even lower because we have much more scrutiny and much more government watchdogs. But it's possible the severities are increasing. He doesn't really talk through that as much. All right, so that gets us through the rubric. So the rubric says what is float, what's the cost of float. Then you have those 6 things we talked about, ending up with experience versus exposure. Then you talk specifically about where experience can really harm you. All right, so we've gone through the paper. These last things we talked about on terrorism risk is really not part of the rubric, but I think it's interesting. This next side where he talks about their operations is really not part of the article, but these 2 paragraphs here are. All right, I do want you to read all of it, and we'll probably come back to some of this other stuff that he talks about. When we talk about reserving, he has a lot of discussion about reserving. But let's get to this paragraph. So he's just talked nonstop about we're assuming these risks blindly without much thought. We don't have much experience. We don't have enough data to price this. And then look at the phrases he used here. Particularly busy. You would think he's just talking about how much money we lost doing something we shouldn't have done. Oh, but gee, he's been particularly busy. No one can match his speed, can offer huge policies. Does this sentence make sense after what he's just said? That's what I want you to talk about. Now, some students say, well, if you read between the lines, he explains it. I'm kind of in the camp of, if I'm writing that sentence, I would say something like, what I said above means we've got to be much smarter and better at it, but it doesn't mean we got to sit on our hands. We're still going to be offering products and making money, and no one can match. I would have caveated that sentence. To me, this sentence, these 2 sentences, particularly busy and no one can match his speed, just seem to me questionable. I'm not going to put words in your mouth. You can certainly say it's perfectly fine. But then look at what he's talking about here. 578 million on a South African refinery. Boy, refinery is a good place to attack. They're not all that well protected. They're sitting out there in the ocean. They're probably not that difficult to take down. $1 billion for acts of terrorism at airlines. What did he just lose money on? An airline terrorism attack. He's going to do $1 billion on non-cancelable third-party liability coverage for losses arising from terrorism for airlines. 500 million pounds for another refinery or platform. 600 million loss elsewhere. Significant coverage. It's almost like he's like, hey guys, it's not small. We're doing huge amounts on Sears Tower. What happened on 9/11 to the Sears Tower, do you think? If you'd been on the 98th floor to Sears Tower, guess what you were doing that day? you're running as fast as you could down the stairs. If any of y'all have ever been, I know it's not the Sears Tower anymore. I forget what it is now. I forget the name of it. Have any of y'all been to the top of the Sears Tower? It's really
Yeah,
cool.
it's the Willis Tower.
Yeah, I hate that building. It's so thin on top that it sways. They told us it sways 18 inches. The day I was there, it was swaying 18 inches. I hate heights. I was so seasick. The bankers, we had a dinner on the top. We had a whole room to ourselves. Everybody's like, wow, this is so nice. This is so special. And I'm like, I can't wait until this evening's over. I'm so sick. I don't like being in a building that's swaying 18 inches. But that would have been a much easier building to take down, I think, than the Twin Towers. It's just not much substance up there at the top. It's really thin at the top. But he's covering that 500 million threshold. We've written jumbo risk as well. Now that's a term for insurance, but still, for World Cup soccer, what's the most popular sport in the world? Soccer. What would be a great place to have a terrorism event? Soccer event. The 2002 Winter Olympics. I actually went to the 2004 Olympics, not as a participant, but as a spectator. We were worried about terrorism risk. And I can tell you, when I was there were times I was thinking, if I was a terrorist, this is when I would set off the bomb. There was a point where we were in this massive long line of subway cars, and we were shoulder to shoulder packed in there like sardines. If someone had set off a bomb on that subway chain, they would have killed thousands of people all at once. And they're doing that. Now, he does put the caveat, we have attempted to avoid writing recent policies from which losses might aggregate. Now, let me be a little cynical here. What's one reason these losses might aggregate? Well, I'm going to argue they might aggregate because he just all wrote them down right here. What did he just do? He just wrote down all the risks that he covers. If you're a terrorist and you're looking for some ideas, there's some ideas. Thank you, Warren Buffett. Why don't we just attack everything Warren Buffett insures? Didn't he just right now connect all of these risks all in one little page? I'm not saying that connects them, but they weren't connected before in your minds. How many of you are connecting the World Cup soccer and the 2002 Winter Olympics? But right there, he did. Say World Cup soccer and Winter Olympics. Wow, those would be two good things to attack. So, in my mind, he's almost aggregating those himself. All right, we'll come back to this. I'm going to stop there. I got to watch the time. I missed the time in the last one. We'll start. We're almost to the end. So we ended up there. This weekend, I would recommend you get a really good draft of this paper out so you can start calling me and talking to me about it. If you wait, like some students do, and start writing it the week before it's due, right now, this paper is fresh in your mind and you understand it all. It's real fresh in your mind. 4 weeks from now, it's going to be like you've never heard this stuff before. All right, so write this paper this weekend, okay? All right, I'll stop there.
All right, let's get started. So let's real quickly just walk back through the outline for paper one, which is what you want to be focusing on right now. Boy, no one's on video. It's like there's no one here other than Ryan. Okay. It helps if I see some friendly faces. So we've been through everything. Let's just walk back through it one more time. There is a rubric. If you look at the paper description, there's a rubric-like thing at the end that shows exactly what needs to be in there. So you start off with what is float. We discussed the different concepts there. It's actually reserves and liabilities. It looks like borrowed money, but there's a time element that's important. So somehow find a way to get all these terms in there in your own words. The cost of float is much more straightforward. The cost of float is underwriting gain or loss. Try to bring the combined ratio in. I forgot to check and see if he actually used the term combined ratio in his write-up. Remember, it excludes investment income. Now, one thing I didn't put in my outline that I think is important is he said, for insurance to really work, the cost of float has to be less than the cost of borrowing money somewhere else. So I think that's an important concept. If you can borrow money in the capital markets at 3%, but your cost of float in insurance is 5%, you might as well not sell insurance and just go borrow the money more cheaply somewhere else. So I didn't put that in the outline, but I think that's important. But the cost of float really is a formula, the way he used it. He showed the combined ratio. He didn't show, I mean, he said our cost of float was 12%, but he's essentially saying our combined ratio was 1.12. And then the principles, I have it broken into 6 things. Expect a profit, but remember I said, price your products in a way that you can expect a profit. He implied like every year, but I don't really think it's every year. I don't think that's possible, especially for reinsurance business, unless they're just really grossly overpricing their business. So I really think he means over time, but he didn't say that. If you can't get that profit because of competitive forces, walk away. You want to limit your business, especially to those extreme events. You have to be able to evaluate the risks. Remember, on evaluate the risk, I want something in terms of frequency and severity in your discussion, but you have the expertise. You want to make sure you consider remote possibilities, including not just a single event, but an aggregation of events, where he uses that great term, ceaselessly search for possible correlation among seemingly unrelated risk. And then the experience exposure, which is actually, I broke it into 2 things. One is to discuss experience and exposure, but then give examples on why experience may not work. You don't have much experience to start with, something like terrorism risk or earthquake, or there's something going on that's changing the world, like DNO, global warming, even maybe terrorism risk. So the first one is you don't have data, so you really can't evaluate the risk well. The second one is the world's changing in such a way that either frequency and or severity are changing. So make sure that's all in. This has always been the weakest part of the paper. Students just, and why is it the weakest? Because I'm talking about stuff that he didn't necessarily have in his article. I'm reading between the lines on that part. And so if all you do is review the article, you're going to miss that part of it. I give you several examples in here. The last one is a piece of cake. It's avoid business with bad people. Remember, the article had a section on about reserving and being conservative with reserving. I put that in there because we're going to talk about it later, but it's not part of this paper. So just leave that. If you put it in your paper, I don't count off. All right. I want to actually show you the rubric though. So let me go get the rubric just real quick. Because I do think that's important. Because there is one really major part of this paper that if you don't get, you're going to maybe be shocked at the end. All right, so we've done all that. So here's the rubric. So it looks exactly like what I just did. You have that page 10 assessment as well. Don't forget that. All right, so that's your coverage part. So don't forget the page 10 assessment. It's actually up here in the description. Provide an assessment of whether you believe Warren Buffett is fully complying with his own risk management philosophy, especially considering the first 3 paragraphs at the top of page 10. All right, don't forget that. The other big one people forget is the second to last one. So coverage is 10%, clarity is 40%, coverage is 40%, clarity is 40%, critical thinking is 10%, but it kind of flows through as I'm grading coverage. And then I have this other. So what other could you bring in there? You might go out and look at his annual report from this last year and see if he brought this up again, if he said anything new. You might go out and do a search on the word float in insurance or float in property and casualty insurance and see what comes up on that search. I talked about the underwriting cycle. You might go research that and see if you can bring something in on that. You know, he talked about, with the underwriting cycle, you know, we mentioned that he said 94 was the last, or 84 was the last time they had a cost of float this high. But 84 interest rates are much higher too. So that could have been a case, not of them being a big catastrophe year, but could have been a year where they just had high costs of underwriting because they're making so much on their portfolio. I don't know. So there's places you can go in and do some additional analysis on this. The word float's probably your best bet because Warren Buffett has made this pretty famous. So if you type float, I could even try it while we're talking. If you type in Google, type float and property and casualty insurance, the true value insurers floats. Now you be careful. I'm seeing some article coming up talking about a floater owned insurance. That's not what we're talking about. Yeah, and someone posted their paper from my class on the internet. Or maybe it's for another class. I don't recognize this one. So it's possible people putting other people's papers out there. If you plagiarize, you get 0, so that wouldn't be too smart, but I mean, you can always look at someone else's paper if you want to. You know, try that, or you might say float and Warren Buffett. See what comes up there. And make sure you spell Warren Buffett correctly. How does Warren Buffett use float? The brilliance of Buffett's float strategy. How exactly does Warren Buffett use float? Boy, that's probably the best one. Float and Warren Buffett, boy, all kinds of stuff come up, including a YouTube. So you can use a YouTube to do this. So you might go on a YouTube and just type Warren Buffett and float, and you can add your extra and say, I saw YouTube where Warren Buffett was talking about this. But Warren Buffett's lifeblood is what industry insiders call float. How Warren Buffett made Berkshire Hathaway a winner. So this is a big deal for Warren Buffett. He's made it a big deal. So you know that's probably something you can cling on to. If you type the underwriting cycle, all kinds of stuff will come up on that. Wikipedia has stuff, and you can use Wikipedia. And I know we're not supposed to use Wikipedia. I don't mind doing that as long as you put your sources. The wonderful thing I love about Wikipedia is all the links that they have. And Wikipedia actually has a really good write-up on insurance float. They say the underwriting cycle is a tendency of property and casualty insurance premiums, profits, and availability coverage to rise and fall with some regularity over time. It's when they tighten underwriting standards and sharply raise premiums after a period of severe underwriting losses. So they're talking about it a little differently than I talked about it, but I'm sure they'll talk about the interest rate linked to that. And they do have links that look really interesting all the way down here. So there's plenty of stuff. So all I'm asking you to do is get engaged with what we're talking about here outside of just exactly what we did here. Do more than so that you can think critically. That's why I have it as, I usually have critical thinking as 20% of the grade, but here I'm splitting the critical thinking up in 10% and then 10% of you doing additional research. All right. So I'm going to leave paper 1. Unless you have some questions, you can always call me and set up time to meet with me or whatever if you're kind of uncomfortable writing papers. Right? And try not to trip there, Mitchell. All right, any questions on that? Looks like everybody's good. All right, so I'm going to jump back up to that third question because it's so closely related. So remember the 3 questions we asked. First was, when should individuals buy insurance? The second one was, should corporations buy insurance? And the third one is what you're dealing with the Warren Buffett article is, what are the characteristics of the losses that allow insurers to actually write the risk, actually insure? And you're going to see a lot of overlap with Warren Buffett. The first thing you have to be able to do is be able to evaluate the risk. And Warren Buffett definitely brought that one up. Some are easy. Life insurance companies, they have a lot of data on when people die based on their age, their gender, their family history, their medical tests, blood tests, those type of things. What could be a risk is some new biological agent like COVID-19 that could be an issue. Car insurance, we've got a lot of data there. But what if the speed limit changes? Homeowners, we've got a lot of data there, but global warming's been an issue because we don't know about hurricanes and those kind of things, but we have a lot of data. Some require very specialized skills like boiler machinery, we'll talk about later. And others are very, very difficult, like terrorism, cyber risk, flood, earthquake, where the data is just a little hard to decipher, or maybe it's just, there's so many of them. And there's so much difference between Katrina was a pretty shocking flood event that kind of took the industry by surprise. The second thing you need after evaluated, it must be obvious. Now, Warren Buffett didn't talk about this one at all, but it must be obvious when you have a claim. You can't have it that someone has a claim and you have to go to court to figure it out. So life insurance, pretty simple. How do you prove you have a life insurance claim? You provide them the death certificate. That's pretty simple. You don't have to sit down and figure out how much was the life worth. You're just going to pay whatever is the face value of the policy. So if it's a $200,000 policy, you have a death certificate, the insurance company pays $200,000. The only exception there might be if they think the person who received the insurance actually murdered the person who was insured to get the claim. In that case, the insurance might still pay, but it just won't pay to the person who got the policy, who murdered the person. For auto, home, and health insurance, here you need some type of evidence of a claim. They may ask for a police report. They may ask for bills from hospitals or mechanics. This is what we call indemnity insurance. Indemnity insurance, what it's doing is trying to indemnify you, try to bring you back to where you were before you had the accident. Life insurance, it's a valued policy, so it just pays whatever the face of the policy is. So all companies have some type of rules for what you got to do so that you prove that you had a loss. We'll talk about this more on homeowners insurance, where it makes some sense to walk around your house with a video camera so that you capture everything you own and then send that video camera, that video file somewhere that's not on your premises. Store it out on some cloud somewhere so that if your house burns down, you have some proof of what you own. The third thing is insurers must be able to control their exposure to non-accidental events. This might be what Warren Buffett was talking about, only dealing with moral and ethical people. So there's two aspects here. There's moral hazard and morale hazard. Now, moral hazard is once someone buys insurance and then they set their house on fire so they can collect on the insurance. That's illegal and you go to jail. That's moral hazard. Morale hazard is when people buy insurance and because they bought the insurance, they act more risky. All right. It's legal, but insurance companies will charge you more for that. So auto insurance is the perfect example. You run out and you buy a $90,000 Tesla and you're about to jump in it and drive home, and then you go, wow, I forgot to buy insurance on this. Boy, I bet you drive home really safely. If you see another car on the road, you probably get off the road and park and wait for them to pass. That night, you probably park your Tesla in the garage and you sleep in your car in the garage. You're really worried. The next day you call State Farm, you buy auto insurance. I bet you drive more risky now that you have the auto insurance. And that's what insurance called morale hazard. The simple fact that you have auto insurance makes you a riskier driver. Now, I don't know if that's true with health insurance or life insurance. I don't know. I've never met anyone that said, I was going to go bungee jumping today, but I don't own any life insurance. Let me buy some life insurance tomorrow. And sure, I'll go bungee jumping with you. And the reason is you've got a lot more skin in the game on life insurance than you do on auto insurance. So you might, it may not be quite the morale hazard. Health insurance, I don't know people who say, I was going to go bungee jumping but I don't have health insurance. Let me buy some health insurance. Then I go, maybe, but still, you got so much more skin in the game. Homeowners probably not either. Mainly because there's not really risky things you can do with homeowners insurance. But with auto insurance, absolutely. With auto insurance, insurance companies are going to charge you more for your auto insurance simply because you bought auto insurance. They know that people who have auto insurance are riskier drivers than people who don't, so they charge you more. And there's no way to get around that. That's morale hazard. The next thing is adverse selection. That's where we know that people who need insurance are more likely to buy it than people who don't really need it. So unhealthy people are much more likely to buy life and health insurance than healthy people are. And actuaries know that. And so they know the simple fact that you bought insurance probably means you're more likely to file a claim. You're probably less healthy. You're probably more likely to die early. Life insurers can protect themselves by charging smokers more than non-smokers, charging people who do risky stuff more than people who don't do risky stuff. They have select and ultimate tables. What they mean by select tables is they charge people who just recently had a health exam less than people who haven't had a health exam in some time. All right. Annuities, healthy people tend to buy annuities more than unhealthy people because annuities pay you until you die. Insurance companies just assume if you're buying an annuity, you must be really healthy. Bad drivers will more likely want to buy auto insurance than good drivers. There's a famous article you might have read somewhere in your auditing class, or if you took auditing. It's called Market for Lemons. It's a really famous article. It's not a particularly great read. Famous article. But essentially what it's saying is if you don't price this correctly, if you don't charge bad drivers more, bad drivers will buy a lot of insurance. And because of that, it's going to cause the cost of insurance to go up. And so good drivers will stop buying insurance. Well, that's going to make insurance prices go up even more. And then other good drivers will drop out. At the very end, no one can afford insurance because all you have is a bunch of really horrible drivers. So you really need insurance companies to be able to price that adverse selection. You really need them to charge riskier drivers more than less risky drivers. So we were not going to talk too much about underwriting in this class, but underwriting definitely helps. Underwriting is how insurance companies that figure out who's risky and who's not risky. Right? Now, if after all of that, the person's just too risky, then you just deny them coverage. You don't insure them. We'll talk about these residual risk pools later. But, it is an issue for the insurance industry. There are people who just are not insurable, and regulators don't like that. Politicians don't like that. And there are politicians out there going, I don't care if they're the riskiest driver in the world and they're having accidents all the time. We got to find some way to get this person insurance so they can drive. So we'll talk about that. Why do regulators and politicians want to get risky people onto the road? I'm going to show you some really risky drivers too. You're going to probably be amazed. Have any of y'all tried the Canada's Worst Driver yet? Watch that TV show. Pretty cool show.
I've watched. There's a lot of Russian ones because I don't think you have to have insurance in Russia. So I've seen those.
Well, try Canada's. It's actually a reality TV show where they actually crown someone the worst driver. I'm going to show you a driver from season 12. There's a lady named Crystal. I'm having trouble believing this person actually exists. If maybe they hired an actress to do this, because there's no way anyone's as horrible as this person. I don't mean horrible as a driver. I mean horrible as a driver and horrible as a person. So I think they kind of exaggerated her, but you'll see. I'll let y'all be the judge of that. Yeah, I do watch those road rage videos. I'm going to show you some of those because I actually think it'll make you a better driver. There's some videos I really like that I think make you a better driver if you watch them. We'll definitely, when we get to auto insurance, I'm going to show you some really, I think, some cool videos out there, and they may shock you a little bit. But there are people out there. This Crystal if you watch that version, season 12, just watch season 12, the very first episode, and you'll see Crystal. I think you'll see what I'm talking about. There's no way she should be driving a car anywhere. And she's very infuriating. There's another season, there's another guy who's a lot like her, always on his phone. And this guy was always on his phone. And he actually, because of that, had a wreck and broke his arm. So now he's driving on his phone with a cast on his arm, so he can barely hold on to the wheel, the steering wheel anymore. And his response is, I don't care how dangerous I am, I need the text. And Crystal's the same way. I had trouble believing these people actually exist. Can you believe people are that horrible? But these are the people on this program. Be interesting to see the worst drivers in the US, because I think we could compete with Canada, but anyway. So we'll talk about that. There are drivers out there that should not have insurance, and we want the insurance industry to deny them claims. And then the politicians come in and say, yeah, but they need to drive. They got to get to work. We got to get them insurance somehow. And so somehow they still get insurance. Now, one way the insurance industry tries to control this is by requiring what's called insurable interest. So if they can try to make it so that the people they sell insurance to really do not want to have a claim. So if you buy insurance on your life insurance on your own life, the insurance industry will assume you prefer to be alive than dead, and you're not going to buy the insurance and then take your own life just so you can get the insurance. Auto insurance, they're going to assume that you really don't want to wreck your car because the cash value in your car is not going to be worth what the car is really worth. It's really not going to be worth it to do that. So they want you to have insurable interest. What that means is you really don't want to have an accident. You really don't want your house to burn down. You really don't want your car to be totaled. So we'll see that. There is some issue with that with homeowners, because homeowners is replacement insurance, which means not like auto insurance. Auto insurance, you have an 8-year-old car, they're going to replace it with an 8-year-old car. You can't replace your house with a 20-year-old house. It's just not possible. They're going to replace it with a brand new house. So there definitely have been people who have burned their house down for the insurance. So that is an issue for insurance, but generally most people don't want their house burned down. They'd rather not. It's kind of a nuisance. So insurable interest is how you protect yourself. We'll talk a little bit about insurable interest later. All right, so the last one I think is somewhat related to Warren Buffett as well. Is there some events that cannot be insured because they're just too massive? They would wipe out the entire industry. So flood. And the insurance industry does not insure flood. And why don't they insure flood? Because it's just too massive. And so the federal government insures flood. You can buy your flood insurance through an insurance company, but they're really just doing that for the federal government. And it's because flood can be so massive, could really wipe out the entire industry. War risk for life insurance is generally not covered because, obviously there's going to be more deaths. Property, we're going to see this in property insurance. War and nuclear bombs, insurance don't cover that. So if North Korea shoots a nuclear bomb at the United States and hits San Antonio, your house won't be covered. You'll just be uninsured. Terrorism risk, that one's been questionable. It is insured, but there's some question about how much it's insured. Earthquake and hurricane risk are the two that the insurance industry is starting to cause waves with the politicians to say, hey, we don't know if our industry can actually cover these risks. They're just getting too big and too massive. Earthquake risk could wipe out all of California. Hurricane risk, who knows how much damage that could do. So we'll see that that volcano that went off the last couple of weeks, that's a scary thing for the insurance industry. These things could really be massive. So what happens if a 100-foot tidal wave hits the state of Florida? Who knows what the insurance, that would be flood. So the insurance industry wouldn't have to worry about it, but we as taxpayers would pick it up. So it's got some overlap with Berkshire Hathaway, especially number one, but it also has some other things in there that he did not cover. All right. So I'm going to jump to page 8 of the notes, the overview of the P&C industry. I call it P&C. Some people call it property and liability. I call it property and casualty, whatever you call it. When I was at USA, we had the USA P&C company, and we had the USA Life company. We just called it P&C and Life. So we use property and casualty. I don't know what the norm is for the industry. I think P&C is more common than property and liability. So insurance is part of the sector financial services. So if you look at the S&P 500, there's like 11 or I get mixed up because they broke out communication services and they broke out real estate. Real estate used to be part of financial services, but it got moved to its own sector. It's the smallest sector in the stock market. It's a tiny, tiny, tiny sector. But financial services includes banks, investment firms, and insurance. And then under insurance, life, annuity, and health is its own industry. And it's usually broken between individual and group. And then property and casualty is its own group. And it's broken not between individual and group, but between personal lines and commercial lines. I don't know why they use the word lines. They use the word lines to mean products and property and casualty. They don't use the word lines in life insurance. I don't know the origin of that. Personal lines, commercial lines, I don't know where that came from. There's got to be some origin for that. They also break out property and liability. Now, you may not notice that. You might say, I have auto insurance. Your auto insurance does cover both property and liability, but we're going to see later in the class when we look at the accounting, they actually consider that two different lines of business. So the property, they have auto property and they have auto liability. So they actually view your auto insurance, they actually view it as two different products. On the property side, there's auto, home, and other. On the liability, there's auto, home, other, and then we start getting into the professional liabilities and the product liabilities. The strangest one for property and casualty is workers' comp. Workers' comp is health insurance, it's disability insurance, it's life insurance. It's a lot of stuff that the life insurance industry covers, but it's under the property and casualty insurance. So the history of this is health insurance at one time was under property and casualty insurance. And then for some reason, it shifted from property and casualty over to life insurance. And disability insurance shifted from property and casualty over to life insurance. But the property and casualty kept the workers' comp. And I think it's because workers' comp is really a commercial lines product. So I think just because of the customer base, it made more sense to keep workers' comp under property and casualty. It's possible there's some P&C companies that do disability and do health. I don't think so, but it's possible. But life insurance companies, they do health insurance, they do disability insurance, they do life insurance, except for related to workers' comp. So if you have a disability policy from a life insurance company, but you get injured at work, that policy will not cover you. Instead, your workers' comp will cover you. All right. So there's some strange history there. And then you have others. I think I'm going to talk about title insurance. I'm in the process of selling real estate, a house right now. This would be, I think one student has done this, but some of y'all others, I don't know if any of y'all are interested in real estate, residential real estate. You want to be a real estate broker? If so, this might be a great paper 2 topic. I hate title insurance. I think it's a ripoff. I think it's a horrible insurance. I'm probably stepping some toes. Some of your parents might be title insurance sellers. I just think it's horrible, horrible insurance. And I can give you, we'll talk about it. I'll show you an article and you can get in much more depth into it. Why doesn't State Farm sell title insurance? Why doesn't USAA sell title insurance? Why is it so ridiculously expensive? And I'll show you why it's so terribly expensive. Now, the industry says it's expensive because of all the services we provide. I absolutely don't believe that, but we'll see. If I'm stepping on toes and someone wants to defend the industry, then let me know. I'm perfectly fine being educated on that. I don't have experience with it because State Farm, USAA, Allstate, they don't sell it by law. So it's a protected industry. But we'll talk a little bit about title. There are other coverages we'll talk about. especially et cetera. All right, so someone needs to mute, please, if y'all see who it is.
Yes.
Can't tell who it is, but someone needs to mute. All right. What about jobs and insurance? Let me, before I get into this, bring up something that's related to this. There's a group called the Insurance Council of Texas, the ICT. Insurance Council of Texas is a trade association for property and casualty insurance companies in Texas. There's a few things I'll tell you about them. First of all, they're real eager for you to work in this industry. They have a goal to get more college students working in the property and casualty insurance industry. Because of that, they have some incentives for you. One thing they do is they provide a scholarship every spring to UTSA students. So this semester, you can apply for that scholarship. We usually try to, well, in the past, we had 5 of them, 5 $1,000 scholarships. And we tried to have 2 actuaries and 3 finance, or 3 actuaries and 2 finance. The problem I've had is I couldn't get 5 students to apply. I think last year, 2 students won, one won $3,000 and one won 2. So they're going to give us the $5,000. They might give it all to 1 student, and they may split it between 10 students. I have so much trouble. There's been semesters where I'm begging students to apply, and they say, okay. And then a week later, they're handed a $1,000 check and say, I'm kind of glad you asked me to apply. So I don't know why I have to beg people to get $1,000. But if you want to apply for this scholarship, if you're an actuarial major, you kind of have an advantage because you've got a degree that works in this industry. So what they do to pick the winners of this, the number 1 criteria they have is your interest and our experience in the insurance industry. So one of the ones that won it the last time, he was actually working for State Farm. So he was already in the industry. That gave him a huge advantage. The other one that won, she was an actuarial major. So she had no trouble. You know, they always see actuaries want to work in the industry. One student applied and she didn't win. And she said she wanted to work in the insurance industry. Where did she go wrong? She said she wanted to work in the life insurance industry. This isn't for life insurance, it's for property and casualty. So I'm just telling you, I'm going to, in the past, they had the application sent to me, and then I sent my recommendations to them. They're not doing that anymore. The applications go directly to them. So I can't help you edit your application to help you win. If you want to show it to me in advance, and I can help you, but I can. This is a small class. I think practically 100% of the winners have come out of this class. So there's only 22 people in this class. So, you know, if you got a good GPA and you want to work in this industry and you got a good story, you got a good shot at winning the scholarship. It could be $1,000 or more. The other thing they do is they give us thousands of dollars for us to spend to promote the industry. And so one thing we've done is for actuaries, we're allowed to use that money to help actuaries pay for their actuarial exams. Since actuary has such a close tie to this industry. Lindy, I think you know where the application is. Is Lindy on this call? I don't see her tonight. So, if you're an actuarial major and you're taking exams, we've gotten an approval. I think it's $300, $300 to $400. I can't remember how much. We can cover your exams up to that much. Email me and I'll forward it over to the person who set this up. One of the students in my class last semester, who's an actuarial major, he set that up. So let me know and we can do that. So look forward to that. The other thing they do is in July, they have a conference, they call it a symposium. It's in Austin. We'll pay all the travel. You can go there, and part of that symposium is they have a jobs fair where they actually sit down and let you interview with insurance companies. So, if you want to work in this industry, we have a really great resource with the ICT. They really want you to work in the industry. They're going to give you money. They'll pay for your exams. They'll pay for your travel to the symposium. So take advantage of that this semester. If you're taking this class, I'm assuming you have some, at least remote interest in this industry. So take advantage of it. And if you apply, they'll give your name out, your resume out. They'll send it to different companies. So, it's a really great resource to have. I don't know if you have any questions on that, but I'll definitely be telling you as we get closer. And then if not enough people apply, the problem I'm having now is since the applications are going to ICT and not coming to me, I don't know who's applied. So last year, I sent out emails to students I thought had a good chance of winning and said, I don't know if you applied yet, but if you haven't, I'd really recommend that you apply. So I might do that this semester. But all right, any questions on that? Don't walk away from free money. So if you're going to work in this industry, where can you work? Obviously, actuarial science majors. You can go to the site beanactuary.com. Great site. It looks like Bean Actuary, but it's actually Be an Actuary. They have a lot of stuff. Maybe .org, I don't know, but Be an Actuary. And they have a lot of information on the industry. And I think that one's really focused on property and casualty. I don't think it delves on the life insurance side. What could you be as an actuary? You could be a pricing actuary, which is really where most start. We have several UTSA alums that are pricing actuaries. That's a very quantitative statistical job where, you're getting as much data as you can. And you're trying to figure out what price to charge for an insurance policy. And we're going to talk more about that. We'll talk about telematics. We'll talk about credit scores. We'll get into that. What input do you need for pricing? You can be a reserving actuary. Those are the actuaries that set up the loss reserves, the loss adjustment reserves, the unearned premium reserves. I had a good friend at USAA who was one of the reserving actuaries. Really wonderful lady named Mary. I wish I could get her to come talk to the class. Maybe she's retired by now. She was about my age. If she does come talk to us, don't tell her that I said I thought she was about my age because I have no idea. But she was a great reserving actuary. She took her job extremely seriously. Really understood it. She's probably one of the best reserving actuaries in the country. But very quantitative job. Reinsurance catastrophe actuaries. There was two of those at USAA that I worked with very closely, Kirby and I forget the other lady's name. Really loved working with them. Kirby's someone I'd love to come talk to this class. I'm going to show you some reinsurance stuff, but all I can show you is the stuff I can get online. I wish I could show you USAA's actual reinsurance policy. But I doubt anyone starts as a reinsurance actuary. They probably start as a pricing or reserving actuary and probably move over. It's a very specialized area. And then product development, USAA does have some product development people. I don't know what new products they're actually developing, but there are new products you want to develop. Obviously, right now we got the gig economy, which is a good topic for paper 2. You have some artificial intelligence stuff. We'll talk a little bit about that with Root Insurance Company. So there is some new products out there that are very, very interesting in this industry that could be interesting for a paper 2 topic. But actuary is the place to be. Now, if you're a finance major and you think you might want to be an actuary, you better decide fast. You don't decide to become an actuary later in life. It's just not possible. Actuary is something you got to start right away. But it is a great, great career. If you like doing math all day long, I mean, that's essentially what it is. Great people. I don't know any actuaries that I've worked with that I didn't really, really love working with. Very smart people, know what they're doing. On the investment side works really closely with the actuaries because of that idea of float. Remember, the insurance business creates the float, those liabilities, and then that float needs to be invested, and the investment world does that. So I worked really closely with actuaries. I needed to tell them what investment return we were going to get off of that float. so that they could incorporate that into their pricing. Underwriting works very, very closely with actuary. In fact, if you're an actuary major and you just can't get the exams done in time, then apply for a job as an underwriter. It's a really great way to start your job as an actuary, start in underwriting. In fact, it might even be a better way to start as an actuary. See what the underwriters are doing, learn that part of it. So they work very closely together. The underwriters are the ones who decide who are the risky drivers, who are the low risk, who are the high risk drivers. Policy service, they take care of the customer, policy changes, address changes. A good friend of mine worked in USA's policy service. I took care of her 401k plan and she took care of my insurance. So I would just call her, boy, she knew what she was doing. Policy service, you don't just know insurance. You know insurance for Texas, you know insurance for Illinois, you know insurance for Florida. Every state is different. And so she helped me when I moved from an apartment to a condo. She helped me understand how to change my coverages. Very smart lady, had a lot of details. There's the sales side. You're selling policies, selling coverage. A lot of companies, we're going to talk about this. A lot of companies are now moving online. I'd be curious when we get to that discussion, how many of y'all have purchased your policy online versus going through an agent? If you're using Geico or Progressive, you're probably going online and buying your coverage there. Claims is a tough job. These are the people picking up the phone and the person calling them has just been in an accident. So it's a pretty stressful job, right? All day long, you're just talking to people who just went through something horrible. So they're pretty stressful jobs. I remember when I was at USAA, the claims people, this was back when we had sick leave versus paid time off. We had sick leave and the claims people, they took 100% of their sick leave. They needed time off. It was a tough job. And it's just stressful. You're just constantly dealing. I knew a lady that worked in claims, not on property and casualty, but on disability insurance. And boy, she was just one stressed out person. So it is a little tough. And a lot of times you're talking not to your customer, but you're talking to the person your customer ran into. And this person thinks you're going to rip them off, that you're not going to pay them enough money, that you're going to take your time. So it can be pretty tough. If you're an actuarial major and you can't get an actuary job because you're still working on the exams, claims is not a bad place to work. I mean, it's a pretty rough place, but it's a great experience for an actuary. I know a former student from this class, she started in claims and she moved not from claims to actuary, but she moved from claims to decision science. The decision science people at USA work really closely with actuaries. And I've had her speak to my class before. She's moved to another job now, so she doesn't speak to the class. But she said working in claims was really quite valuable to her. It is a tough job. And then you have the normal staff functions, accounting, finance, those type of things. And then insurance companies have regulatory affairs people. These are the people who deal with all the bureaucracy of every state insurance commissioner. So yeah, it's a tough area. I've had, I think I told you I had the former insurance commissioner of Texas talk to our class. I had him speak to the class twice, but then they moved our class back to 9 o'clock. It was just too late for me. He's an older man. It's interesting. I have a student in my other class who has the same last name as that guy. So I'm going to have to ask her, that might be her grandfather. So maybe we have a connection with him still. But this is a very regulated industry. And so we'll definitely get into regulations. Any questions on jobs? I don't know if any of you are working in this industry. Last semester or last year, we had a student from State Farm. I have had a few students working in an industry. But if any of y'all work in the industry, you want to let me know that would really help me. I know this industry really well in some areas, other areas are more textbooky because the company I work for just didn't sell those policies. I've always been in finance. I worked a lot with actuaries. I've worked some with underwriting, but I've never done policy service or sales, so I don't know some of the details of these policies that they would know at the policy service level. So if you have some experience, let me know, and I'll certainly call on you to give us some background. And the last thing I want to cover on the industry overview is the legal structure, because it's a fairly unique industry. So the industry has stock companies, mutual companies, and reciprocals. A stock company is just like you normally know, like Allstate. Allstate is an insurance company that's publicly traded. It's a stock. You can buy it just like any other stock of any other company. A mutual insurance company is like State Farm. It's a non-public company. You cannot buy, you cannot invest in State Farm. It's owned by its policyholders. So yeah, it's not investable. A reciprocal is also owned by its policyholders, but it's a very special type of legal structure where the CEO has this kind of power of attorney over all these and all the customers. It's a really unusual company. It has very favorable tax treatment, pretty amazing tax treatment. I learned this doing investments at USAA. USAA is the only company I know whose after-tax return on stocks is higher than their before-tax return on stocks. I just can't think of any other entity that actually has a higher return after tax than they do before tax. It's just really bizarre. Reciprocals are just a really strange animal. So mutuals and reciprocals, they can own subsidiaries that are stock companies, but they're wholly owned by the parent. So State Farm is a mutual insurance company, but they own State Farm Life Insurance Company, which is a stock company, but State Farm Mutual is the only one that owns State Farm Life. So you can have private stock companies, public stock companies and private stock companies. So mutual insurance companies like State Farm, Mutual of New York used to be, but Mutual of New York is now a stock company. We'll talk about that. But Northwestern Mutual, those type of companies, they're owned by their customers. A reciprocal, the only two reciprocals I really know are USAA and Farmers. And Farmers is a little bizarre itself because Farmers is actually owned by somebody else. So I really can't explain Farmers to you. Very strange company. But USAA is kind of maybe the best known of the reciprocals out there. Most stock companies, Allstate is a stock company, but if you look at the actual company you're buying when you buy their stock, you're not buying Allstate Property and Casualty Insurance Company. You're buying a holding company that owns all of their insurance companies. And the reason for that is that you don't want to have public stock and public debt in a heavily regulated company like an insurance company. Banks are the same way. Most banks have a holding company that owns all the banks. So, it's just a way to avoid the regulation. Insurance company is so heavily regulated, you don't really want to mix that regulation with the SEC regulations of issuing debt, issuing equity. Mutual insurance companies and reciprocals, they can't have a holding company on top. So what USAA does is pretty interesting. USAA is reciprocal. It's actually the top company is a reciprocal. It owns everything else. But USAA reciprocal actually owns a holding company. And that holding company does all of USAA's public debt. So you can't have a holding company further down below. But holding companies are interesting. We'll probably get into this when we look at Allstate later. And we look at their legal structure, and you'll see that Allstate has a holding company over everything else. Now, Prudential, Mutual of New York, used to be mutual insurance companies. They used to be owned by their policyholders, but they did something really strange. They demutualized. What is demutualized? That's when a mutual company switches from being a mutual insurance company to being a public stock company. So Prudential demutualized, Mutual of New York demutualized. When Mutual of New York demutualized, they actually changed the name of their company officially to MONY, money. So the MONY used to stand for Mutual of New York, but they're no longer a mutual company. So now they're just money. Why did they go public? They say the reason they went public is they say it gives them better access to capital. They can issue stock. I think the reason they went public is so that their management could get stock options. I think that's the real reason. They wanted to make more money, but who knows? So there's been a lot of companies that have demutualized in the last several years. I don't know of any companies that's gone the other direction, a stock company that mutualized. So what happens? So if you look at Mutual of New York, money, pretty cool name. So my parents had a Mutual of New York life insurance policy on my life. And Mutual of New York went public. And my dad actually thought that he had lost the life insurance in my life because Mutual of New York actually sent him shares of stock. So he became a stockholder in Mutual of New York, but he still had the life insurance. They didn't cancel the life insurance. What a company has to do to go public is they sit down with the regulators and they decide how they're going to divvy up the company with all their policyholders. So they actually send all their policyholders stock. And then Mutual of New York can actually issue more stock on the public markets. So I actually ended up with, I don't know, a few $100s of stock in Mutual of New York. And I sold it and just got the money back. And I can't remember what the tax consequences of that was. But I ended up, I got a few shares of Mutual of New York. My brothers were asking me, because they did as well. They said, do we keep it? What do we do? And I said, well, were you planning on buying stock in Mutual of New York before this happened? They said, no. Then I say, well, then sell it, because if you weren't going to buy muni stock, money stock, why would you hold on to it if they hand it to you? So I just sold it and say, be done with it. So that's how it happens. And so when Prudential went public, they had to get a plan, and Prudential obviously has a lot of policyholders. They had to get a plan. So how are they going to distribute that to all their policyholders? But none of your insurance changes. You still have the same insurance with that company that had before. All right, so that's the overview in the industry. Any questions on that? Any of y'all are planning on working for this industry? I can probably, I still have some contacts that I could probably show you. I'm starting to lose my contacts because I've been retired now for 10 years. But I still have a few. What's interesting now is my contacts now, and this you really should take advantage of. Most of my contacts now are UTSA alums. USAA especially loves UTSA, and they hire a lot of UTSA students. We probably have 20 to 25 of my former students are working there, and they're all over the place. So take advantage of that. If you want to apply at USAA, I've got some contacts that I can get to you. Do well in the class. If you make a D- in the class, maybe not. But if you make an A in the class, yeah, I'll definitely help you with that. USA is a great company and definitely has, the insurance lines that you can work in. So, it's definitely an option. State Farm's a great company. Allstate's a great company. There's a lot of companies out there. Buckle's another company that has been hiring UTSA students. They just started hiring. I worked with the CEO of Buckle when I was at USAA. She went from USAA up to Buckle, and they've hired, I know they have at least 2 of our former students and there. So we have some contacts in the industry. So it is an industry that's definitely think about. It's a big industry. It's a useful industry. Obviously, we need these companies. So, leave it on your list of things to do. So I don't see any questions here. All right, where are we going to go next? So we're a little ahead on the syllabus. So I think what I'm going to tell you is I'm sitting in a room where the temperatures are dropping to like the 20s, and I don't have a cap like Mitchell does. So I'm about to freeze to death. So what I'm going to tell you is where we're going from here and what you can do next. So where we're going here is we're going to go product by product. We're going to start with homeowners insurance. We're going to do an overview of the product, And then we're going to go through the policy forms high level. I'm not going to teach this like a typical company where we go, a typical class where we just go in minute detail in the policies. So we're going to keep it fairly high level. So we'll walk through that. In fact, I might be skipping through some parts of the notes. I'll just say, just read it. You can just read it yourself. So the big parts of homeowners is property and liability. So we'll talk the property side, we'll talk the liability side. We'll cover all of that. You'll see several pages. There's some interesting concepts and there's some stuff that's a little more tedious. After we do that, we are then going to cover some special issues in property and casualty. So our first special issue is mold. It's going to take us a while to get there. Now, why am I covering mold? It's a pretty old issue. It's several years ago. What I want to do is find an issue that was really meaty. There's a lot to talk about. And it could happen again, but in a different topic. And this was such a big deal for Texas. I want to get into it. And then on the exam, you'll talk about mold. And then I want you to tie it to storm surge. So that's the first issue we'll talk about. The second big issue we're going to talk about is catastrophes and catastrophe risks, which to me is a pretty interesting one. And in there, we're going to get into the problem of maximum loss, and we're going to actually cover risk securitization. All right, so that's the way the rest of the class is going to go. I'm going to take a policy, we're going to walk through it in somewhat detail, but not over minutia. Then we're going to cover some special issues. Then we'll go to auto insurance. We'll go to the policy, and then we'll go to the special issues. All right, so that's really the next few weeks of this class. So you can read ahead if you will, but I really don't think you should do that. If I were you, I would be doing two things in this class right now. Get paper 1 done and start looking for topics for paper 2. That's really what I'd recommend that you do right now. Okay. All right, I'm going to let y'all out 15 minutes early just because we're on schedule and I'm freezing. So there are some times I'm going to ask you to watch some videos outside of class. So, you might go a little over on those. So this is good. We'll make up for it otherwise.